Don't forget to like, share, and subscribe for more investment tips. Now let's get started. Are you looking to invest your money but unsure where to start? Well, you're not alone. Many of us find ourselves in this situation, often overwhelmed by the sea of financial jargon. But don't worry, we're here to simplify things. Investment vehicles are essentially tools that can help your money grow over time. They come in many shapes and sizes, each with its own unique features, benefits, and risks. From stocks and bonds to mutual funds and ETFs, from real estate to cryptocurrencies, the investment world is vast and varied. Our goal today is simple: to break down these investment vehicles into bite-sized pieces, making them easy to understand even for beginners. We aim to help you appreciate not just what these vehicles are, but also how they might fit into your journey. By the end of this video, you'll have a basic understanding of various investment vehicles and their potential benefits. So let's dive in and start exploring this fascinating world of investment. Let's start with the basics. Stocks and bonds. Stocks, also known as equities, represent ownership shares in a company. When you purchase a stock, you're buying a piece of that company, sharing in its successes and failures. They come with a level of risk, but also the potential for significant returns, especially over the long term. On the other hand, bonds or fixed income securities are quite different. Buying a bond means you're lending money to an entity, be it a government or a corporation. In return, you receive periodic interest payments and eventually, the return of the principal amount you lent. The risk with bonds is generally lower than with stocks, but so are the potential returns. Both stocks and bonds have their place in a diverse investment portfolio. They balance each other out, with bonds offering stability and stocks providing growth potential. Stocks and bonds are the building blocks of many investment strategies. Moving on to mutual funds and exchange-traded funds. Mutual funds are a type of investment vehicle where funds pooled from many investors are used to invest in a diversified portfolio of assets such as stocks, bonds, or other securities. They are managed by professional fund managers who use their expertise to try and generate returns for the investors. Exchange-traded funds, often known as ETFs, are similar to mutual funds in many ways. They also pool investor funds to create a diversified portfolio. However, there's a key difference. ETFs are traded on stock exchanges, much like individual stocks. This means they can be bought and sold throughout the trading day at market prices, providing investors with greater flexibility. Both mutual funds and ETFs offer the benefits of diversification, which can reduce risk by spreading investments across a range of different assets. They also offer the advantage of professional management. Mutual funds and ETFs offer a diversified approach to investing. Now, let's explore some alternative investment vehicles. REITs, or real estate investment trusts, are companies that own or finance income-generating real estate. They offer a way to invest in real estate without buying property directly, but they can be influenced by property market trends. Certificates of deposit, or CDs, are time deposits offered by banks with fixed terms and interest rates. They're considered low risk, but the trade-off is that returns are generally lower compared to other investments. Options are financial derivatives that give the buyer the right, but not the obligation, to buy or sell an asset at a predetermined price before or at the expiration date. They can offer high potential returns, but they also carry a high level of risk. Futures contracts are agreements to buy or sell an asset at a predetermined price on a future date. These are commonly used for commodities and financial instruments, but they can be complex and risky. Precious metals like gold and silver offer a tangible investment that can act as a hedge against inflation. However, their value can be volatile and influenced by global economic trends. Cryptocurrencies are digital currencies operating on decentralized networks. They've gained a lot of attention in recent years, but their value can be extremely volatile. Savings accounts are interest-bearing deposit accounts offered by banks. They provide a safe place to store money while earning a small amount of interest, but they don't offer high returns. Annuities are insurance products that provide a stream of payments in exchange for a lump sum investment. They're often used for retirement income but can be complex and have high fees. Collectibles like art and antiques are tangible assets that may appreciate in value over time. However, their value can be subjective and influenced by trends and tastes. Hedge funds pool capital from accredited investors and employ various strategies to generate returns. They can offer high returns, but are often only accessible to high net worth individuals. Venture capital and private equity involve investments in private companies, either in their early stages or through direct ownership and management. These can offer high returns, but also carry significant risk. These alternative investment vehicles provide a wide range of options for different investor needs. Choosing the right investment vehicle is a crucial decision. From stocks to bonds, mutual funds to ETFs, and a myriad of alternative investment vehicles, the financial landscape is vast and diverse. Each instrument carries its own level of risk and potential for return, as well as unique features and benefits. Stocks or equities represent ownership shares in a company, providing a claim on part of the company's assets and earnings. Bonds, also known as fixed income securities, are debt instruments where you lend money to an entity in exchange for periodic interest payments and the return of the principal at maturity. Mutual funds and ETFs offer a way to pool your money with other investors to invest in a diversified portfolio. They're managed by professionals, which can take some of the burden off individual investors. Then there are the alternative investment vehicles, such as REITs, certificates of deposit, options, futures contracts, precious metals, cryptocurrencies, savings accounts, annuities, collectibles, hedge funds, and even venture capital and private equity investments. Remember, each of these vehicles has its own set of rules and risks. The key is to align your choice with your financial goals, risk tolerance, time horizon, and the prevailing market conditions. If you're looking for long-term growth, stocks or mutual funds might be your best bet. If you're more conservative, bonds or CDs might be more suitable. If you're willing to take on more risk for potentially higher returns, you might look into options, futures, or even venture capital. But choosing an investment vehicle isn't a one-time decision. It's a dynamic process that should evolve as your life circumstances and the financial markets change. Therefore, it's crucial to conduct thorough research or consult with a financial advisor before making any investment decisions. A professional can provide personalized advice based on your individual circumstances and goals. In conclusion, investing is a powerful way to grow your wealth, but it requires careful planning and decision-making. As you venture into the world of investing, remember this golden rule. Diversification is key to managing risk. So, don't put all your eggs in one basket. Spread your investments across different types of assets to create a balanced portfolio that can weather the ups and downs of the market. Remember, diversification is key to managing risk. Happy investing.